Hi everyone, welcome back to the channel. In this video, we are going to talk about rise and fall of the dot-com bubble. Imagine a time when just having a website could make you a millionaire. When people believed that if your company's name ended with .com, you were destined for greatness. It was a digital gold rush, a time of chaos, greed, wild dreams. This is the story of the dot-com bubble. A story of how the world fell in love with the internet and then got burned by it. The year was 1991. Tim Berners-Lee had just introduced something called the World Wide Web, a network of information that anyone, anywhere could access. At first, nobody knew what to do with it. It was clunky, text-based, and mostly used by researchers. But then came the web browsers, Mosaic, and later Netscape, and suddenly the internet became human. You could browse pages, send emails, even read the news online. The media called it a revolution. The stock market called it an opportunity. And by the mid 90s, everyone wanted a piece of it. The early internet felt like a new frontier, unclaimed, unregulated, and full of possibility. It was like discovering a new continent. But as with all gold rushes, it wasn't long before people come running with dollar signs in their eyes. In 1995, something big happened. Netscape went public. Its stock price doubled on the first day of trading. A company that had never made a profit was suddenly worth almost $3 billion. Wall Street had found its new religion, the internet. From that moment on, any company with a .com on its name could attract millions in investment. It didn't matter what they sold, books, dog food, groceries, or dreams. Venture capitalists began throwing money at anyone with a website. College kids with PowerPoint slides were becoming millionaires overnight. News outlets ran story after story of people who get rich simply because they believed in the web. It was a modern gold rush. Investors didn't want to miss the next Amazon or Yahoo, and that fear, the fear of missing out, became the most dangerous fear in the market. By 1998, the dot-com bubble mania was in full swing. The mantra was simple: get big, fast. Growth was everything. Profit didn't matter. If your website had traffic, investors assumed money would eventually follow. Startups spend millions on ads, fancy offices, and launch parties. Even companies with no revenue were being valued in the billions. The symbol of this madness: Pets.com, a company that sold pet food online. They had no profits, terrible logistics, and a talking sock puppet mascot that starred in a Super Bowl commercial. Their slogan was "Because pets can't drive." And yet they raised $300 million and went public at nearly 300 million valuation. Less than a year later, they went bankrupt. But back then, no one cared about reality. Analysts on TV said this is a new economy. Old rules didn't apply. Traditional valuation was dead. That's when you know a bubble is forming. When people stop asking, how does this company make money, and start saying, it doesn't matter, it's the future. Then came March 2000. The world changed overnight. The Nasdaq, which had soared from 1000 points in 1995 to over 5000, began to fall. First slowly, then all at once. It started with the Federal Reserve raising interest rates. Suddenly, money wasn't cheap anymore. Then a few big dot-coms announced disappointing earnings, or rather catastrophic losses. Investors panicked, and when investors panic, they sell. The dominoes began to fall. Within months, billions of dollars evaporated. Startups shut down overnight. Venture capitalists pulled funding. Employees came to work one morning and found the doors are locked. The Nasdaq fell nearly 80% from its peak. Over $5 trillion in market value vanished, and companies like Pets.com, Webvan, and eToys became cautionary tales. It was brutal. People lost everything. The same media that once glorified the new economy called a dot com. By 2002, the party was over. The dream of instant online riches had died. But not everything was lost. The companies that survived, Amazon, eBay, and a small search engine called Google, had something that others didn't: real value. Amazon refocused, cut costs, and built an empire of logistics. Google developed the algorithm that would redefine how we find information. eBay kept connecting buyers and sellers around the world. These companies proved that internet was the future, but not the fantasy Wall Street had imagined. It wasn't about high post stock prices. It was about solving real problems. The crash was also left behind valuable infrastructure: fiber optic cables, data centers, an entire generation of engineers who had learned what not to do. The infrastructure became the backbone of the modern web, powering YouTube, Facebook, Netflix, and the entire online economy that followed. The dot com bubble wasn't just a financial event, it was a psychological one. It revealed something timeless about human nature: our ability to believe that this time will be different. Every generation has its own version. The housing bubble of 2008, the crypto boom of 2017, the NFT and AI hype of the 2020s. Each time the pattern repeats, a new technology appears, early adopters make fortunes, everyone else rushes in, and eventually the dream collides with reality. But even in failure, there is a progress because every bubble leaves behind something useful: infrastructure, innovation, or lesson learned. The dot-com bubble gave us the roadmap for how to build the internet we have today. It separated illusion from innovation. Thanks for watching.